Hi there, traders. This is Brad Gibble with the FX Market Insight for Tuesday, the 17th of March. All right, so here we go. The markets continue to tumble, and what we're really looking at is basically the equity markets, right? So there's a lot of fear, there's a lot of money caught up in the US equities. I think there's a bit of a scramble to get your cash out of those as quickly as possible because no one really knows how long this whole virus and all the things that go with it, how long it's going to last. So we just have to wait and see how it plays out. But I think the initial shock wave, we may be through it. There's a few different articles here. I think the US, basically a safe haven. It's the one country, or it's the country that is least dependent on exports to survive. So that's one reason why the dollar goes up. But, there's a bit of initial euphoria that the Fed may be able to contain this or keep things on track. Now, to me, I don't think so. I think equities will get hit harder. The main thing, when we had the financial crisis back 08, 09, the equities, the interest rates were higher. And through that whole situation, everyone was still working. Farmers are still growing. No one, really lost their jobs. Now we've got a situation where schools are shut, borders are shut, and everyone's being told to stay at home. So this is a completely different game. We may see the same sort of result as in a strong dollar, but it's pretty hard to work out whether the central banks can hold these things up. Now, we had the biggest drop here on the stocks, US equities, I think in about 30 years. It's a nice day to sort of think about. Now, if I just give you a look at the Dow, right, just have a look at where this thing is. Now, it's dropped, 9,300 points. So almost 32% in 5 weeks, right? Now, the key to this, to me, this is a long-term weekly chart. If you're looking at the stock market, you can see how we're sort of working around this support level around 20,810, I think it comes in at. Now, we're now below that, and all we've got is Fibonacci levels. So the next level for me on the downside is 18,000, and then the last Fibonacci, the 61.8, is at 15,000. So to me, this is where they're heading. I'd say more down to here than anywhere else, but we'll just have to wait and see how things go. Now, don't forget, the markets have just shut down. So we're not going to start to see the economic numbers for probably a month, but they will be dramatically weaker, and that's when the central bank has to try and work out what they're going to do next. So to me, there's no saving the equity markets. But when you come back and have a look at the whole spectrum of what's going on here, you'll see the currency markets are settling down quite nicely, right? To me, we're starting to get into not really poor markets, but average market conditions. Aussie still cruising to the downside, as so is the Kiwi, and so is sterling. Now, the odd one out here is Euro, which is just cruising sideways. It's just petering away. I know it's a little bit lower, but it's not exactly racing away with it at the moment. So to me, Euro has potential both sides of the market because we've got support and resistance both sides. To me, I'm really looking to get short Aussie, Kiwi, and sterling. They make good sense. You know what? I don't think we're going to see it, but dollar CAD's going to keep going topside as long as oil keeps falling. So trying to get some of those on a dip would be seems to be beneficial. Dollar yen, okay, the one currency pair that was moving around the last number of months around this whole virus issue and a number of other things, the safe haven trade, that seems to be off the table, right? The safe haven traders aren't trading it; they're not selling dollar yen, because the dollar traders are buying dollars. So to me, dollar yen is definitely on the sidelines, and you're starting to look for the other pairs to see what's going on. Now, the dollar, okay, on a perspective basis, as in the dollar index, it's looking pretty good. We've got a short-term sort of bounce. It's looking okay. We're seeing dollar yuan sort of stabilize. It's been flying around all over the place. I still can't work out why it's not 100 or $1 higher, or maybe that's $100 higher at 8, with the issue in China, right? So no one really knows or believes what's happening in China. That's the big issue that we've got. Now, if I just bring you back, let's just have a quick look at the, before I go to the daily trade routine, let's just have a look at the risk on, risk off page, right? So just trying to identify what's happening. Now, as I said, the risk on, risk off appetite comes and goes, right? It'll come in waves. Now, we've seen a lot of the actions the Fed's done. As I said, US equities down 12 to 13% here yesterday. But have a look at the Asian equity markets, the yen equities, or Japanese equities, I should say, stabilizing. They were down about 4%. They're now just come back to flat. The Aussie and Kiwi equities, well, they're Aussie's up 2%, like a bit of a bounce from the 10% drop yesterday. We'll see how that goes. But this is a bit of stabilizing in the markets. The yen crosses, as I said, the safe haven trade, this risk on, risk off profile is not in play in my mind. And if you have a look here at the correlation matrix, just look where I've got the equity markets on the x-axis and the currency pairs on the y-axis. Of course, the yen crosses are in play with the equity markets. They are following them, okay? As the Dow goes up, they go up. As the Dow goes down, they go down. But have a look at the one aspect here, dollar CAD. I mean, it's got a negative correlation with all those equity markets. And if you look at the 10-year bonds, the euro has a very high negative correlation. So as the 10-year bonds fall, you're seeing euro rally and vice versa. So keep an eye on that if you do have access to the data. So once again, if you don't get caught up in the risk on, risk off profile, because some days it's on, some days it's off. To me, it's like the boy who cried wolf. The noise initially is very reactive and very easy to pick up. Then it starts to wane, right? You start to lose the whole momentum. I think the next couple of days in the equity markets are going to be pretty important. If the US equities stabilize and they have a day of like down, like small or even a slight positive day, that will take a lot of the fear out of investors, and we may see that stabilize, and then we'll wait for the data to roll in. I hope it happens, because then it brings back a lot of normal activity to the markets. Now, once again, if I just bring you over now, just give you a look at the, actually, I don't need to bring you over anywhere. Let's just have a look at the daily trade routine, where I've got a bit of this data up. So with the currencies now sort of stabilizing, and I mean, they are missing levels, but trading conditions are moving back towards more like average, right? You can see the pairs that are going down. Of course, the market driver is still the one thing that we can't see, unlike the fundamental data. But you know what? I've had these pairs up the last part of last week, and obviously still now. These are the pairs that have clear direction. The one thing they are missing, right, the key component here, are both like levels to get into the thing, right? Like the dollar CAD so far away from 137.95, it's inconceivable that you'll get them back anywhere closer. And these other pairs, except for sterling, don't really have any support levels to sell through. So that's the problem here. We don't have the levels to get in, right? The currencies to me, on the watch list, dollar yen, euro, and dollar Swiss. Tell you what, we're waiting to work out whether to buy or sell these pairs, because at the moment, it's not exactly clear. They are sort of, if anything, trading sideways. Now, if you have a look at all these pairs, though, is there a fundamental driver coming out? Yes, there is. And that's because we've got US retail sales figures. Now, these fundamental numbers are still probably too close to the raw nerve of all this stimulus package which is being rolled out. But keep a close eye on the average earnings index, or the employment numbers out of the UK. You get the German zoo economic sentiment numbers. If these numbers aren't bad, they will get bad very quickly as the sentiment sort of turns. And then you've got the retail sales and industrial production numbers coming out of the US. Also, some Canadian manufacturing sales numbers there as well. So starting to get some US numbers, which is usually in good market conditions, great for us. Is it going to move right now? Well, I tell you what, we're looking for sort of signs like the Fed are going to react to weak numbers. I think these numbers won't be impacted by what we've already seen. But if they are, well, then we might see some dollar weakness come through there. The tricky part of actually assessing that is the Fed have already said they're going to do whatever it takes if we do start to see weak numbers. So maybe weak numbers, you see a weak dollar initially, and then the dollar starts to rally, as that would suggest there's going to be more stimulus packages thrown into this. All right, so pretty tricky conditions overall. But as I said, the currency pairs, the major currency pairs, are looking pretty good. As I said, like there's some pairs here which are set up. To me, looking for opportunities to get short some of these key pairs does make a lot of sense. Of course, we're going to wait for the random news that comes out. And I think you'll start to see a lot of these central banks, global central banks, coming out and suggesting, or admitting, yes, we're heading towards a global recession. That's probably inevitable with this, because I don't know how long this whole quarantining is going to be in place for. So what you really, to me, the one number now that we're looking for, and you want to keep a very close eye on, is the employment numbers, right? And this is where today's UK data really comes into play. Employment, right? You can sort of start to gauge employment from these levels. I would expect if they're going to make people stay at home or shut schools, we're going to see the unemployment rate of a lot of these currencies go through the roof. And that is probably something they can't hold back. All right, guys, that's it from me. So concentrate on the main pairs. Once again, the raw nerve is the US market. So keep a close eye on US equities in particular, right? That's where the action will revolve from, all right? And if you do have access to the to some data, I was having a look at the treasury markets. The 30-year US treasuries are going through the roof at the moment, as you'd expect. The government is, or the Fed has got these things moving. 10-year, I mean, all the bonds are sort of shifting higher, so keep an eye on those. And don't forget that 10-year is very responsive, negative reciprocal relationship with euro, so keep a close eye on that. It'll basically tell you where euro's going. All right, and that's how you need to follow the markets in these current conditions. All right, guys, have a good one. Cheerio.